morning everyone, it's Friday the 4th of September, and in news today, USD to rise or fall, the debate rages, gold wins. Last night saw the US share market fall sharply, with the NASDAQ down 6% at one stage before finishing down nearly 5%. The S&P 500 was down 3.5% and the Dow was down 2.8%. In USD, gold was down 0.6% and silver 3.5%. Only the falling AUD saw that change to plus 0.3% and minus 2.2% respectively. Cryptos were clubbed across the board, including BTC below US 10,500 and Ethereum back below US 400 at one stage. And against the whole USD is dead crowded trade, it maintained its upward trajectory from its low on Monday. That short, the USD trade has been one of the most epically crowded trades you'd see in a while. The charts below, courtesy of Macro Insider's latest Raoul Pal deep dive, show the extent of this. First, DXY USD index on the futures market was fully 2 standard deviations oversold. Check out this graph, guys. Every hedge fund short of the USD, the next chart coming up, shows aggregate USD position. The scale and spread of different managers of which is quite amazing, with non-commercial asset managers both deeply short and leveraged funds heading to zero. Check out this next graph, guys. Net USD positioning. The DXY is dominated by the euro on the other side, so it should not be a surprise that euro futures are now in their longest position ever. But why? Because if you lose faith in the numerator, you need to be confident in the denominator, and that's largely the EUR. The narrative for this newfound faith in the euro is of just one hard-fought agreement to mutualize debt and bail out the PIIGS, as we reported here at this time. Here's the next chart, guys. A lot of the reasoning for the rotation was that the Eurozone was over COVID and the US was one of the worst places in the world. While the latter is still true, Europe is seeing a strong surge in the second wave and far from out of the woods. People have quickly forgotten how long it took to get agreement on that bailout package, and MOAR is not guaranteed when it is needed. The euro economy is still very, very sick and does not support a high euro if confidence restores to the USD. There was another interesting interview recently on Real Vision around the perception that all this QE is going to weaken the dollar because it is inflationary, pumping new money into the system. However, the interview between dollar milkshake theorist Santiago Capital CEO Brent Johnson and Stephen Van Meter has them positioning that because QE doesn't actually create new normal money, rather reserves in the respective commercial bank Fed's account, that it is, as intended, suppressing rates and yet consequential intent of people borrowing more of the banks who have these new reserves is not happening as everyone is too scared and is instead saving. The money required to buy this 80 billion a month of bonds is of course coming out of the economy and yet ultimately ending up in those reserve accounts. And so ineffective is removing liquidity, not adding it. That of course is deflationary, not the widely adopted view of imminent inflation. That, you will recall, falls neatly into Raoul Pal's The Unwinding thesis as well, that we have laid out previously in our previous articles. The debate between the two of these will no doubt continue to rage, but as all participants appear to agree, there is one winner either way, that's gold. The weak USD and inflation case is pretty straightforward, as that has always been bullish for gold. The strong USD and deflation takes further insight more into the reaction rather than the event. Their thesis is that the reaction of the Fed and government fiscal spending will be massive, as they will have the double whammy of negative inflation and zero rates, i.e. positive real rates at a time when negative is desperately needed amid a recession and massive debt pile. It will also be accompanied by a huge crash in shares. That reaction would see a huge rotation into gold. Powell's updated outcome is as follows. My expectations for the 2020-2022 insolvency are: economic growth remains negative for an extended period, bond yields fall to zero and then negative as the deflation sets in, safe haven assets such as Bitcoin and gold will rise sharply, the equities of indebted firms or firms exposed to insolvency will fall, the overall price of equities will fall for an extended period, and the dollar will strengthen and then fall. That some of the greatest minds are debating which way this goes highlights the extent of the uncertainty in this world today and the massive imbalances as asymmetric nature of markets. That most are confident in gold highlights that when things aren't normal, when so unbalanced, gold can protect at each end of the risk equation because one thing is predictable, and that is human behavior at each of those ends. That is especially the case when said humans have amassed an unprecedented amount of debt and some of them want to get re-elected. Our trademark is balance your wealth in an unbalanced world. Just saying. So that's the news today, guys. Thank you for joining us this week. For any Bullion products, please visit ainslieBullion.com.au. And for any of our crypto products, visit ainsliewealth.com.au. Have a good weekend and we'll catch you guys on Monday. Bye.